Hello and welcome back to the Geordie Pig Investor channel. Today we're going to have a look at, is Target Corp stock a buy right now? What is Target Corporation? Stock ticker TGT. Target Corporation is an American retail corporation that operates a chain of discount department stores. It is the 7th largest retailer in the United States and a component of the S&P 500. The company is one of the largest American-owned private employers in the United States. Target is notable for its focus on upscale, trend-forward merchandise at lower costs. Its stores typically sell general merchandise including clothing, household goods, electronics, toys, and more, as well as groceries. Target expanded throughout the US in the late 20th century, cementing its place in America's popular culture. Its main competitors include Walmart and Amazon. As of 2023, it operates 1,948 stores throughout the United States. Some key stats about Target: they are based in the United States. They are part of the consumer staples industry, have a market cap of $59.6 billion. They went public in 1967, have over 400,000 employees, have a whopping 40-year dividend growth streak, have a very nice 5-year dividend growth rate at 11.3%, and they have a very nice dividend yield also sitting at 3.46%. They've recently, in the last month, been down 13.39%, and in today's video, we're going to have a look at, is Target stock a buy, hold, or sell right now? Target's earnings call and fundamental analysis. In the third quarter of 2024, Target reported a modest 0.3% rise in comparable sales, driven by a 2.4% increase in traffic, which was offset by a 2% decline in average ticket, indicating cautious consumer spending. Operating income grew by 6.7%, although the EPS fell to $1.85, down from $2.10 a year ago. Looking ahead to Q4, Target anticipates flat comparable sales, projecting ETS to stay between $1.85 and $2.45, with a full year EPS range of $8.30 to $8.90. The firm plans significant capital investment between $4 and $5 billion in 2025, supported by a robust digital sales growth of nearly 11% and a 20% rise in same-day delivery usage. Target's management is focused on navigating through current challenges while emphasizing the importance of resilient consumer behaviors. Consumers are currently showing resourcefulness, waiting for promotions, and valuing price over brand loyalty. This evolving behavior is prompting Target to double down on providing both new, exciting merchandise and sustainable, competitive pricing. Notably, the company aims to maintain an appropriate inventory position to ready itself for a rebound in consumer spending in 2025 and will continue to invest in areas that promote convenience, such as same-day delivery and digital shopping experiences. Some fundamental analysis for Target is that it has a positive free cash flow of $4.5 billion, exceptional 3-year revenue growth at 35%, positive operating income at $6 billion, positive gross profit at $30.5 billion, positive net income at $4.4 billion. They also have very good long-term solvency, a low debt to equity at 0.99, high Altman Z-score at 3.21. They do have poor short-term solvency, hence why they have that current drop in price. And they do have positive net debt at $10.9 billion. Moving on, we're going to have a look at Target's free cash flow. Free cash flow is the money a company has left over after it pays for all of its expenses and investments it needs to make to keep a company running smoothly. Free cash flow has a massive impact on the direction a company may be heading, as if it has negative free cash flow, this is a really bad sign, as the company may have to look then to reduce dividend payments or make cuts in other areas of the business. Target has a fairly steady increasing cash flow since 2022. They then actually had a negative free cash flow in 2023, and it was primarily due to a combination of factors related to its operations, inventory management, and capital expenditures. Target did see slower sales in 2023, which definitely impacted their free cash flow, but Target has also been investing heavily in store upgrades, technology, and infrastructure as part of its ongoing strategy to enhance its supply chain capabilities and expand its digital presence. These capital expenditures can temporarily drag down free cash flow, especially when the company is spending heavily on long-term growth initiatives. Since then, Target has improved across many areas, including inventory management, cost control, and margin improvement, and focusing on e-commerce. They have had a very healthy payout ratio, only 46.7%, and don't forget that dividend has also been increasing for 40 years, so it is more likely to be one of the most reliable companies out there. The first valuation I'm going to look at for Target is something called the discounted cash flow valuation. The DCF is a method of estimating the current value of a company based on projected future cash flows adjusted for the time value of money. The DCF valuation process calculates the present value of a company's forecasted cash flows based on selected operating models. Target's current price is $130, and when plugging in a discounted rate at 7.9% and a terminal growth rate at negative 2.9%, we can see Target will be worth $85.32. When plugging in a discounted rate at 7.6% and a terminal growth at 0%, Target will be worth $140.20. And when plugging in a discount rate at 7.2% and a terminal growth rate at plus 2.9%, we can see Target would be worth $263.59. Not only do I look at the discounted cash flow valuation, I also look at something called the relative valuation. This is a method used to value a company by comparing it to other competitors based on certain metrics. The metric it includes is EV to revenue, EV to EBITDA, and PE ratios. When plugging in my numbers for Target, we can see on the worst case scenario they'd be worth $162.11, on the average case scenario being worth $183.41, and on the best case being worth $202.75. From this information, we can actually come up with something called the intrinsic value. When valuing a stock by combining the relative valuation with the DCF valuation, it will calculate the intrinsic value. The intrinsic value of a stock has been used for many years to calculate stocks and is easily calculated by simply adding the two together and dividing by 2. The worst case scenario for the intrinsic value of Target is $123.72, average case being worth $161.80, and the best case being worth $233.17. Once I have my intrinsic value, I then look to get one more valuation method for a company so that I feel confident in my analysis. This is the Wall Street estimates. Wall Street estimates are an average estimate of a public company's quarterly earnings and revenues that lead to a valuation of that particular company. These numbers are forecasted by a company-specific analyst who provides research on that company and therefore comes with what they believe is an accurate valuation. A company the size of Target is going to have multiple analysts looking at it, which is why I'm even more confident when I see these valuations. On the worst case scenario, they believe Target would be worth $120.19. On the average case, they believe they're worth $179.52. And on the best case scenario, they believe they would be worth $220.50. What does this mean then? Well, now that I've got my 3 valuations, I can combine them and get my final best, average, and worst case scenarios for Target and see if it's really trading at an attractive price right now. On the worst case, we can see Target would be worth $122.54. So with a 10% margin of safety on the worst case price, you'd be looking to buy Target at $110.29. With a 20% margin of safety on the worst case price, you'd be looking to buy Target at $98.04. On the average case, it was worth $167.71. So with a 10% margin of safety, you'd be looking to buy $150.94. And with a 20% margin of safety, you'd be looking to buy Target at $134.17. And on my best case scenario, we can see Target would be worth $228.95. So with a 10% margin of safety, you'd be looking to buy $206.06. And with a 20% margin of safety, you'd be looking to buy $183.17. What does this mean for Target? Is the stock a buy right now? As a dividend-focused investor, Target presents a compelling case to be part of your dividend portfolio due to its strong track record of dividend growth, financial stability, and commitment to returning value to shareholders. While Target is currently navigating a complex landscape filled with cost pressures and shifting consumer preferences, the long-term trajectory remains intact. The company is well positioned to leverage its robust business model, diverse product offerings, and digital enhancements. As the retail environment evolves, Target's strategy focuses on adaptability and consumer engagement, ensuring that it can continue to deliver value to shareholders in the years ahead. The company's ability to consistently grow dividends and deliver solid performance in both favorable and challenging market environments makes an excellent choice for those seeking stable and growing income from their portfolio, especially with its recent drop in price and the value shown with my valuations. Currently, on my average case price with a 20% margin of safety, the buy price would be around that $134 mark, which it is currently under. Do you currently own Target in your portfolio? Let me know in the comment section down below. What other stocks would you like to see a full breakdown on? I hope you enjoyed today's video. Please like and subscribe. Thanks for watching. This is the Geordie Pig Investor, over and out.